Hello traders, welcome to the E-mini Thunderdome. If you're new to this channel, we are a channel that focuses on streaming ES and MES live trades, usually Monday through Friday. You want to follow along with my trades, subscribe and click on the little bell so you can get a notification of when I start my streaming. I don't always trade the same time, and also I don't trade every day, so by clicking the little bell, you'll get notified of when I start. Okay, if you do follow my trades, you'll be doing so at your own risk, because I'm not liable or responsible for any losses. This is pure entertainment. All right, in this video, I'm going to be going over Elliott wave principles. Okay, if you don't know what Elliott wave is a fractal pattern based on impulse and corrective waves. A man by the name of Ralph Nielsen Elliott, he started to notice that the market moves in a pattern of impulsive, corrective, impulsive, corrective, impulsive, and then a full correction, and then it resumes the trend. And to me, it is the best indicator. Elliott wave and Fibonacci are the only indicators that could actually plot a target. It could tell the future. You know, everything else, all other instruments, indicators are all based on past information. Fibonacci and Elliott waves are the only one that could show you where the market can go. Okay? All right, let's get started here. I'm going to turn off my camera so you can get a full view of my slides. Okay, here we go. All right, so I put together a quick study guide. If you'd like to have one of these, I'm going to put a link to my email. Shoot me an email and I'll reply with one of these quick study guides. So let's start. Start by choosing a time frame and then go up or down by 3. So an example, 3-minute, 5-minute, and 15-minute chart. Look for connections from one chart to the other, fit them all together. Before you reach any conclusions that you have read the wrong wave pattern, look at other time frames. The pattern could be a correction or impulsive wave from a bigger time frame. Each time frame is a fractal of a larger or smaller fractal. Everything is connected. So all charts are always connected. So an example, my pre-market studies and setup, I usually look at a daily chart. Why? Because if I'm seeing, if it's a Thursday and you know the market has been green for the past 3 days, chances are that today, Thursday, is going to be a negative day. Chances are, I mean, there is no rule. Trading in the market is random, so there's no rule, but chances are. So always look at the bigger picture and then come down to a smaller, more focused, or do the opposite, either outside in or inside out. Okay, so here is the 5 wave pattern. So you got wave 1, 2, 3, 4, 5, and then a correction. Okay. Wave 1 and wave B are always going to be the hardest waves to figure out. If it has started, it is the hardest one. So, you know, start looking at the end of 2 and the beginning of 3. Okay, so wave 1. Okay, that's right here. It's going to follow by wave 2. Usually, a wave 2 will be a simple ABC. So impulsive waves are going to be 1, 2, 3, 4, 5, and corrective waves are gonna be an ABC. Okay, so wave 2 will never exceed wave 1. So when it's correcting, it will never surpass wave 1. It has to stop at 1 or before 1. Okay. And that's going to be followed by wave 3. This is the big money-making wave. Okay, on the example I'm going to show later is not the longest wave, but usually wave 3 will be longer than wave 1 and longer than wave 5. Okay, this is where you're going to make most of your money. Okay, and that's going to be followed by wave 4. So if wave 2 was a simple ABC, wave 4 is going to be a 1, 2, 3, 4, 5. It's going to be a fractal of this whole picture right here on wave 4. Wave 4 should usually stop before or at wave 1, but sometimes it will exceed. But that is not the rule. The rule is before or at wave 1. But we have been seeing a little bit of a extension. I don't know if you use Fibonacci, but now Fibonacci, usually the retracement, the pullbacks are going to 76. They're no longer stopping at 61. The trend is usually to 76. Okay, so this sometimes it will breach, but it should stop at the end of 1 or before, right? It's going to be a 38.2% pullback into wave 3. So you want to get your Fibonacci retracement, and you want to retrace starting at the beginning of 3 to the end of 3 and see where 38.2 is. So it'll either be a little bit, it will either stop at 38 or go to 50. Okay, so in between 38.2 and 50% is where wave 4 should stop, and then wave 5 will start. So here we talked about truncated wave 5. What is a truncated wave 5? Wave 5 is the only wave that could stop before, at, or after the previous impulsive wave. So it could stop before 3, at 3, or it could surpass 3. Okay? And then that's going to be followed by a full correction of a minimum of 61.8%. Okay? So then you would start a retracement from the beginning of 1 all the way to where you figured out where 5 ended, and you're going to pull the retracement, and you're going to look for a minimum of 61.8%. Wave A will usually stop where wave 4 ended and wave 5 started. Okay? But again, wave A and 1 are the hardest waves to figure out where they have started or finished. So if you're gonna do a correction trade, you should start at the beginning of C. Try to figure out where B ended and go for a C trade. Okay? So a C trade will either end at 61.8 or it will end at 76.6. Okay? Alright, let's go to the next slide. This is the 5-core Elliott wave pattern. So you got 2 impulsive and you got 3 corrective. So the market will always be correcting more than will be trending. Okay? So that's the 5 impulse. You could actually use a diagonal trending line to figure it out. Okay, use again Fibonacci, and then you have the corrective waves. This is a sideways ABC correction. It's called a flat. Okay, flat. Then you have a triangle ABCDE. Then you have a zigzag, but you could also have a double zigzag, even a triple zigzag. So it will be ABC followed by another ABC, and then sometimes even another ABC. And let's look at some real examples. So this is a 3-minute chart. Okay, so in this chart I noticed that there was an ABC. So this one ended at 61.8% of the previous. Okay, it didn't go to the 76. And then here 1 is hard to figure it out. So is this one here the blue line, or is this one? So it's a lot easier to do a correction here, a retracement of 61 or 76.6, and then look for a wave 3. So anything within this box here could have been the end of wave 2, and now I'm looking for the impulsive longest wave. Even though 5 is longer here, this example, it's still 3 is usually the longest. So on 3, you'll have a minimum 3, a middle 3, and a extended 3. Okay? How do I know that this is not 3? Because if I do a Fibonacci retracement here on 4, 4 ended before wave 1. So this could have been 1, or this could have been 1, right? Right here. This is not 1 because the pullback here is not enough. So it's either here or here. This looks like a complex 1, 2, 3, 4, 5 within wave 2. 1, 2, 3, 4, and then wave 5 is actually wave 3. So on wave the end of the ABC, if it is a complex, it will turn 5 will turn into a wave 3. Okay. So this is not a wave 4. So then this is wave 3. Okay. And then we do the retracement of wave 3. So we would figure out where wave 3 started. We do a retracement of a minimum of 38, maximum of 50. So this looks like it went a little bit into wave 1, and then wave 5 starts. So again, wave 5 could be a truncated 5. So it could have ended here, it could have ended here, and it could have ended here. This looks like a super extreme one. Okay? So this is where wave 4 could have ended, and this is wave 5. Okay? But this wave 5 is not a perfect wave 5. So this could be a flat ABC. Okay, ABC. So this, I think that this is the end of 5, and this is a flat ABC, right? Flat ABC. You don't have to count this wave here. You can start here. So ABC. So I think that's what we're seeing here. ABC. And it did a full extension of 76% here. So now, you know, I see the pattern. So I would have been the beginning of 3 here, or the beginning of 5, I would have looked at a higher or lower time frame. Okay, so I'm giving the example here of all the waves, but either here or either here, I would have gone to a higher or lower time frame to correlate if I'm actually seeing a wave 3 or a wave 5. So let's go to a 5 minute. So in a 5 minute, I see a 1, 2, 3, 4, 5, or I could have been looking for a trade off of a 5 minute. I could have been looking for a wave 5. Okay, am I really in a wave 5? Let's go look at a 3 minute, and the 3 minute is trending up. It looks like there's a wave 3 here. So either I could have been, you know, doing a trade setup off of a 5 and correlating with a 3, or looking at a trade setup with a 3 correlating with a 5. So a 5 definitely shows that we are in an uptrend. Okay, 1, 2, 3, 4, 5. But then here at the end is like, oh, okay, what am I seeing here? So at the end of the 5, okay, or I could have went even at the end here, you know, the start, since a 5 minute chart, I mean a 15 minute chart is slower, anytime within this move here, I could have been looking at a 15 minute chart, and I would have said, ooh, I don't see anything. So if we are on a wave 5, at the end, when I figured out that 5 has ended, this here is the 5-minute chart. I would have said, okay, at the end of wave 5, I'm not going to do anything. I'm going to sit tight and wait for the market to show me more, to show me some cards, show me more information. Here's an example of a flat ABC. So this here could either be an ABC going down. This could be a complex ABC, or it could be a 1, 2, 3 up, okay, or it could be a ABC or a 1, 2, 3. So at the end of this here, I would have said, okay, I'm stepping back. I'm not gonna do anything. Probably wait till tomorrow, because nothing is really clear on the 15-minute chart. I can't see anything. Okay? So that's how you correlate between a higher and a lower time frame. So if I'm a swing trader, if I'm an investor, I'm going to be going long past 4,200, or going short past 3,600. I'm not going to play within here anymore. Actually, I got lucky here. That should be clear. If you guys don't get it, send me an email and I'll try to reply, but I think it's pretty much self-explanatory. Okay? I do suggest a book, and the book that I suggest is Elliott Wave Trading by Wayne Gorman. I'm going to put a link, a Amazon link right underneath. It's a great book. He actually, within the book, he has links to videos, trade setups, that trades that he actually has taken. So, great book. I think he actually has some YouTube videos also. You can go and find them on YouTube under Wayne Gorman. Alright guys, don't want to be too long here. We're already at 17 minutes. If you learned anything, please click on the thumbs up so it could help the algo, so other traders could find this video, so they could also learn how to use Elliott Wave in their trading and make some money. Alright guys, thanks for watching, and I'll see you in the Thunderdome.